Hi guys, it's yours truly Jeremiah Wosu, the CEO of Jerry's Forex Academy. So welcome to my YouTube channel where you're going to gain mastery when it comes to forex trading. In my earlier video, I gave an introduction to forex trading, which I delved deep into it. If you've not watched that video, please I encourage you to go watch that video on my YouTube channel. So today we'll be looking at risk management and position sizing. And you would agree with me that before anyone is successful when it comes to forex trading, okay, in this industry of speculative, investment business, you would agree with me that there is need for you to best understand what risk management is all about and what position sizing is all about. For so many persons out there, so many YouTubers, they've not really done justice to to this topic, and it's one of the reasons behind why so many persons are still not profitable when it comes to trading and why they keep losing their money. So before I dive deep into this video, into this teaching, please I encourage you, if you've not subscribed to this YouTube channel, please I encourage you to please subscribe to this YouTube channel and then turn on the notification bell, because I'll be releasing more and more video on my YouTube channel on all it takes to become a profitable forex trader. And please, I'll encourage you to please subscribe so that once I upload this video, you're going to be the first that will be alerted about this. All right. So, without wasting much time, let's go into the business of today. So, what's risk management and position sizing? So, in the topic today, we'll be looking at some key areas. One of it is risk to reward ratio. Another one is setting up stop loss as well as target profit. Because before you can take a position, either a buy or a sell, there is need, professionally speaking, to have a stop loss and a target profit. Okay. Likewise, position sizing. I'll teach you guys on how best to size your position in order for you to minimize risk and maximize profit. And then lastly, I'll take you guys on the psychology of a trader. What ought to be your psychology, how you ought to think in order for you to be profitable while executing trade is very important, because if your psychology is affected, of course, you won't be profitable, because trading itself involves psychology, emotions. Okay. All right. So, what's risk management? Now, management has to do with you determining your risk appetite, and I call this risk appetite per trade. Now, I want you to understand that risk management in forex trading varies. Number one, it varies amongst individual, and number two, it varies among dependent on your account size. Meaning, it is your account size that should determine your risk appetite. Take for example, someone with $1,000 account size will be willing to risk as high as $100 on just one trade, or even $500 on just one trade, depending on what he is willing and comfortable to lose. Okay. But then someone with let's say $50 account size, of course that account size is very small, so your risk appetite ordinarily should be little. Do you see that it varies among individuals and then account sizes? But as we dive deep into this video, you're going to learn how best and what ought to be your risk appetite on a particular trade in order for you to become profitable. Mind you, is to minimize risk or loss and then to maximize profit. So it has to do with your risk appetite per trade. And then we also told that this enables you to best implement a set of rules and measures while executing trade, and you being able to manage your trade properly. That's what risk management is all about. Now, what about position sizing? Of course, this refers to the size of a position within a particular portfolio. For example, you have a $1,000 account size or a $100 account size. That's your portfolio. That's your dollar amount that you brought in. That you gave your broker that you want to trade with. Okay, that's position sizing. It has to do with the size of your account. Okay, for know that an investor uses this position sizing to help determine how many units of security they can purchase, and which will help you to control risk and maximize return. What it's trying to tell you is, let's say you funded your account with $100, for example. you discover that with that $100, you'll be willing to buy more and more positions that are worth even $2,000. Okay, but mind you, have just $100. So what this implies is that um, this position sizing and through what we call leveraging lot sizes, as we progress in this video, you get to understand all what I mean. You discover that your broker will be willing to give you these privileges, this leverage to trade even more positions beyond just your $100 that you have in your account size. Okay. All right. Now look at the lot sizes I was just mentioning a few minutes ago. Now when it comes to forex trading, okay, there are different lot sizes. In fact, there are four major lot sizes that you have on the screen. Number one is your standard lot. This standard lot size is one lot, and it's what in units it is what 100,000 units. Okay. Now this lot is also called leveraging. It is this 1,000 units that with your $100 account size, you'll be able to buy a position beyond just $100. You can be buying a position of $1,000 that you can trade with, you being able to speculate on the on price movement, and then you profit as price moves your direction. Okay, so this standard lot is what your broker measures this based on what 1,000 units. Okay, while your mini lot size, this is 0.10 lots, and in units is what 10,000 units. This is how your broker would measure those price moves and then determine what should be your profit as your target profit is hit. While your micro loss as you have is 0.01, and unit is what 1,000 units, and then nano is least is what 0.001, and unit is what 100 units. Now I want you to note something here, that the units, okay, this unit that you have, your 100 and your 100,000, 10,000, 1,000 and 100, okay, this unit represents your lot size of the base currency. As we progress, you're going to understand what I mean by base currency. Let me just give a little example. For example, you are trading Euro USD. Now, Euro is your base currency. USD is your quoted currency. In other words, Euro is your primary currency. USD is your secondary currency. Okay, so each of these units represents what the base currency that you are trading, the pair. Now, what's account risk? Now, I want you to understand that before an investor, for example, okay, would approach want to use an appropriate position sizing, okay, for a specific trade, he must be able to determine his account risk. Now, this typically gets expressed as percentage of the investor's capital. As we all know, the rule of thumb that most retail investors risk no more than 2% of their investment capital, which is powerful. You've heard the likes of, George Soros, Warren Buffett, great forex traders who were profitable. These forex traders were profitable. Why? Because they follow this rule of thumb. They are willing to risk just no more than 2% of their investment capital. You know, and that's what has enabled them to be profitable. All right. Now let's see this example. Let's say an investor has a $25,000 account size. Okay, that is his net liquidation, and he decides to set his maximum account risk at just 2%. Just 2%. His account size is $25, and then he's able to risk just 2% of his account size. Now, at this point, you notice that they cannot risk more than 5,000 per trade. That is, when you do the math, 2% of $25 is what? $500 per trade. That's what you know that he's risking. Now, if perhaps or peradventure this trade goes against him, what do you notice? He has just lost just $500 outside his $25,000. So you see that he's still left with $24,500 to still trade with. That's the benefit of risk management and position sizing. Now look at this. That even though the investor has over 10 consecutive trades in a row, all right, he has 10 consecutive trades in a row. What do you notice? He has only lost just 20% of his investment capital. And what's 20% of his investment capital is just $5,000. So you can see that for the fact that he took 10 trades and all 10 trades was, came out all negative. He lost money. He had just lost just $5,000. Now, $5,000 minus $25,000 is what? He still has $20,000 to still trade with and make profit. And mind you, in this business of forex trading, this industry, there's what we call statistical edge. Now, your statistical edge will only play out when you stay long in the game. In other words, when you have money to trade with. The moment you don't have money to trade with, you blow your account, you lose all your money in your account. There's no way your statistical edge is going to play out. All right, and there's no way you'll be profitable. That is why there's need for proper risk management and position sizing. Okay, now what are the steps if you want to put them for in order for one to calculate his position sizing? Now, one of it is what? Check your net liquidation, and your net liquidation is what? Your capital. All right. Number two is determine your risk per trade. You should tell yourself how much are you willing to risk on just this one trade. And now underneath this, you are advised that the risk refers to what? The maximum loss per trade. And this is the maximum you can lose on any one trade if it hits your stop loss. And you are professionally advised not to risk more than 3% of your account size. Meaning, if you want to risk between 1% to 3% of your account size. Never you go beyond 3% of your account size, because when you do, it's tantamount to you what? Gambling. And forex trading is not gambling. You are trading. You know what trading is all about. And there are risks associated with trading. All right. And no matter how good your strategy perhaps may be, there's need for you to work, ensure proper risk management and proper position sizing in order for your statistical edge to play out. As we progress in this video, we're going to see all what I mean by statistical edge, and we're going to see, going to do some little arithmetic, and you see for yourself that of a truth, there's need for me to ensure that I preserve my capital in order for my statistical edge to play out at the long run. Number three is um, you being able to determine your position size. There's need for you to determine your position size for each trade. All right. Now look at this. Once you have calculated your position size in units, you can then convert it into lot size. And this is the formula that you have on the screen for calculating your lot size. And the formula says net liquidation, which is your capital, multiplied by your percentage risk per trade, all over your stop loss distance times your dollar value per P. Now let me break each of these four terms to you down. Now your net liquidation represents your capital, okay? And then your percentage risk per trade represents your risk to reward ratio. That is, how much are you willing and comfortable to lose on this particular trade you want to go into? And you are advised professionally, and this is the advice I give my community of traders in Jerry's Forex Academy, that never you risk more than 1% to 3% of your capital. Meaning, you should be willing to risk a minimum of 1% and a maximum of 3%. Don't go beyond 3%, because when you do, you are gambling at that point. Okay, and your statistical edge may likely not play out. And then your stop loss distance, this has to do with your entry price, that is the difference between your entry price and your stop loss. Don't worry, I'll show you a graphical representation on a live chart, so you're going to understand what I mean. Okay, and then your dollar value per pip. This is dependent on the pair that you are trading, because this varies among pairs. For example, Euro USD, its dollar value per pip is what? $10. But then other pairs have their own dollar value per piece. Pairs like the GBP JPY, the Euro US AUD, CHF, all these pairs have their own individual dollar value per piece. And I'm going to show you guys manually how you can calculate this dollar value per pip. And then once I'm done showing you guys manually, I'll then show you how you can use the automated calculator, your position sizing calculator, how you can use it and calculate your number of lot sizes. But there's need to still know it manually, but then I'll show you once I'm done showing you manually. Okay? Now, let's see an illustration. Now, look at this illustration, how to calculate your number of lot size. Via net liquidation, okay, let's say you have a net liquidation, in other words, you have an account size of $10,000 and your risk per trade, that is how much you are willing to risk on that one particular trade, is just what 1% of your account, which is nice. And then your stop loss distance, you are willing to risk just 20 pips, okay? And then the pair you are trading with is Euro USD, and its dollar value per pip is what? $10. Now, going by this formula that you can see on the screen, okay? Your number of you calculate your number of lot size. Now your net liquidation is what? $10,000, because that's what the capital. This is your account size. This is the money you funded your account with. So that's what $10,000. Multiplied by how much are you willing to risk on this particular trade? Is just what 1% of your account size. Okay, which is this. And then your stop loss distance is what? 20 pips. And then your percentage value per pip is what? $10. And mind you, I mentioned this percentage dollar per pip is dependent on the pair you are trading with. Now, when you do the math, okay, you discover that is what? Is $50. Let me bring my calculator over here. So look at this. When you multiply 20, okay, you multiply by 10. How much is it giving you? You can see it's giving you it's giving you $200. Okay. Now look at this. When you divide this, okay, I want us to do the math together. Okay, so that it will make more sense to you. Is what? 50. This is how we arrive at what? 50 pips. Now when you divide this by 100, okay, you'll be having what? 0.5 lots. So in other words, you'll be using a lot size of 0.5 in order for you to maintain you risking this 1% of your account size. Now, mind you, your leverage in here is what? Because you are trading on is what? 1,000, it is 100,000 lot size. Because you are trading on one standard lot. Okay, when you do that, if you do the approximation, it's one lot. So it's 1,000 lot size. Now, it's 100,000 units, which represents what? One lot size, one standard lot. Now, when you multiply this by 0.5, you are having what? 50,000. Now, this 50,000 is the price, is your buying power that your broker gave you. That's the buying power of Euro USD being your base currency. That's the buying price. Remember, your account that you have is just what? $10,000. This is the amount you have in your account. But now you can see that you are able to buy a position worth $50,000, meaning you are having 5 times leveraging, which is this. When you do 50,000 divided by 10, it's 5 times leveraging that your broker gives you due to what? Lot size. Okay, because lots means leveraging. Okay, this is what it means. So that being said, let's also see how you can determine your position size. Now, still going by this formula, okay, net liquidation times your percentage risk per trade all over your stop loss distance times your dollar value per pip. Now, let's see another illustration where you still have an account size of $10, and at this point, you are risking just 3% of your capital, which is the maximum I told you professionally. That's the professional advice I'm giving you, okay? In order for you to preserve your capital and then for your statistical edge to play out in the market as you trade further. Because losses are inevitable because the market moves in fractals. Okay? So it's very good for you to preserve your capital. So when better setup comes that is more promising, you can trade and accumulate wealth that so that could cover so that your losses that you encounter can be covered and you be more profitable at that point. Now let's see this scenario where you are risking just 3% of your account size, okay? And your stop loss distance is 30 pips. And then your dollar value per pip, you are still trading euro, so it's $10. Now look at this. You have account size of $10,000 multiplied by if you are willing to risk 3% of your account size and then 30 pips, which is your stop loss distance, and then your dollar value per pip is $10. You can see that everything amounted to 100%, and when you divide it by 100, it's one loss. Okay, and then in euro is 1,000 is what 100,000 um, buying power that your broker is giving you to buy this position with a one standard loss. And you see the benefits of leveraging that your broker gave you. You being able to use $100,000, of which you have just $10,000, but you're able to buy a position worth $100,000 to trade and make money for yourself. That's the power of trading. Okay. So that being said, there are things I will need you to know about trading. Okay. Now, one of the things you need to know about trading is, regardless of where you place your stop loss, okay, your risk still remains the same. For example, you risking maximum of just 3% of your account size, which is my advice. I always give risk just 3% of your account size in order for your statistical edge to play out. Now, determine your stop loss first before you calculate your number of lots per trade, because you see, your stop loss distance is directly proportional to what the lot size that you have to use. The farther your stop loss distance from your entry price, the lesser lot size you should use. Because if you are using a bigger lot size, you are then at that point you are endangering your account. You're over risking your account. But the closer your stop loss distance from your entry price, you discover that you can use a much more larger lot size, okay, and make money for yourself. And then number three is that the number of lots traded is inversely proportional to your stop loss, as I just mentioned. Okay. All right. So that being said, so I've been able to show you guys how you can calculate your number of lots manually. Okay, your lot size manually. Now to show you how you can use the calculator. Okay, so you can just to download this position size calculator. Just go to my fsbook.com forex calculation position size, and it brings it for you. Like over here, I have it here. So this is the position size calculator. Once you just Google, look at this, my fsbook.com forex calculator position size. It brings it for you. So this calculates your position size for your number of lots for you in flip seconds. Like now, you can see the pair we are trading is what Euro USD, and the account the currency is what um, dollar. Now the account size is what, from the example I gave you, the last example where we have $10,000 account size, your stop loss distance was 30 pips, and then your percentage risk per trade, you are willing to risk 3% of your account, and then your dollar value per pick is 10. So let's use that example. And remember we had $300. Okay. Now let's see this. What it will give us. Our account size is what? 10,000. Your risk per trade, you are willing to risk 3% of your account, which is the maximum that I advise. And then your stop loss distance is what? 30 pips. Now let's do the calculation. What do we have? Can you see? $300. That's what we are risking on this one particular trade. Meaning, if this trade should go against you, they are losing just what? $300. Now, $300 minus $10,000. You are still left with what? Nine and nine and you are still left with $9,700 in your trading account. Okay, so that's the power of what? Risk management. In this forex business of forex trading, always look at what you will risk. before you think of what you will gain. That's one of the ways you can best preserve your capital. So you can see here we are risking just $300, and then the unit is what? 100,000 units, which is one lot size. As I showed you, look at it, one lot. So you can see the beauty of what using your position size calculator. You can just put these values and it gives you. Now, remember the dollar value per pip. I said it's dependent on the pair you are trading. So you can just come here, click on it. It will be, you can see you have list of all every other currency you want to trade with in this world. They are all here. So and all these have their own individual dollar value per pip. Okay, so whatever pair you are trading, just come here and you get everything for you as easy as that. All right. So that being said, now let me show you a graphical representation of this position size. Now look at this. Remember your entry price. Now this A signifies your entry price, B signifies your stop loss distance. Okay. Now look at this. You are entering at 1.2821, and then your stop loss is at 1.2809. Now, how much are you now risking? You are risking 12 pips. Let me bring back my calculator for you so this will make more sense to you. Now, look at this. You entered at 1.2821 minus this is your entry price, okay? Your A is your entry price, your B is your stop loss distance. Now look at this, minus 1.2809. What do you have there? 12 pips. This is how they came about these 12 pips. Is that why we use the word stop loss distance? In my last example I gave you where we are risking 30 pips. This is how they arrived at it. So here is 12 pips. And the rule is risk 1% of your account to make 1% return on investment. But I advise at least 1:2, meaning you risk 1% of your account to make 2% of your account. When you risk 2% of your account, aim at making 4% of your account. And when you risk 3% of your account, aim at making 6% return on investment. Like at this point, look at it. When you risk 1% of your account, which is 12 pips, you are willing to make 1% return on investment, which is your targeted profit at this point. Now, when this price you are seeing is on an uptrend, okay? When it moves and hits or gets to your take profit, you just make 1R, meaning you just make 1% return on your investment. Now, if this price you see moves, get your take profit too, target profit too, you just made 2% return on your investment, meaning you targeted 24 pips. You just made 2% of your investment. Likewise, when you see price moves this way, moves, get to this take profit tree, you just made what? 3% of return on investment, meaning you just made 3R. I see it. This is the beauty of what? Position sizing. You must know for a fact what you are doing. Else you go and over leverage your account and you end up blowing your account. Okay? So that being said, the same thing applies here. Okay? Let me bring back my calculator. Let's also do the math. So you can see here you enter, this is your entry price. Okay? Which is what? 1.3580. Okay? This is your entry price. And then your stop loss. Okay, we want to calculate our stop loss distance is what? Is what 1.35 1.3534 is what's our stop loss distance is 46 pips, meaning from this point to this point you are willing to risk just 46 pips to make this percent of return on investment. Now let's calculate our percentage return on investment. Let's do the math together. Now these are our take profit, these are target profit, which is 1.37 Okay. Now, when you minus it from your entry price, which is 1.35, I'm doing this so that you see what I'm doing and you understand better. 0.8 is what? 176 pips, meaning you risk 46 pips to make 176 to target 176 pips. I repeat, you risk 46 pips to make 176 pips. Now, let's see the difference when we divide this by 46. We want to see the number, we want to see your percentage return on investment. What did you notice? You just made 3.8, which is 4% return on investment, meaning this interpretation, you risk 1% of your account size to make 4% return on investment, which is a perfect and a beautiful trade. This is how you can make money when it comes to forex trading. Okay, this is how you can calculate your risk. You can ensure proper risk management, and then you can better size your position. Okay, so that being said, let's move further. Now, there are things you need to know about position sizing and likewise risk management. One of it you need to know is risk management ensures that you keep your losses small, and so you would always have enough equity, which is capital, to keep trading in the event of the losing streams of trade you may perhaps encounter. Okay, so there is need for capital preservation. That is the first thing when it comes to forex trading that should be in your mind. How can I preserve my $20 that I just funded now? How can I preserve my $50 I just funded now? My $100 I just funded now? How can I preserve it? That's the first thing that will come to your mind. And that's what risk management. Now the rules are these. Always risk a fixed percentage of your capital, and it's advised professionally that risk a minimum of 1% of your account and a maximum of 3% of your account. Don't go beyond this. When you go beyond this, it's tantamount to you what? Gambling. And it's not sustainable. You can't amass wealth when you do this. Okay? Now look at this. Number one is this. Now let's see the mathematics. When you risk just 1%, okay? When you risk just 1% of your capital, now in event of four losing streams, let's say you enter a position, let's say on this particular day, and then on the first trade you lost money, sorry, hit your stop loss, you enter another trade, hit your stop loss, the third trade hit your stop loss, fourth trade hit your stop loss. What do you notice? You just have 4% drawdown because you are using 1% risk. I see. Now, when you are using 3% risk of capital, which it is the highest advice, don't go beyond this. What do you notice? In the event of four losing streams that you encounter, what do you notice? It's just 4%, it's just 12% drawdown, which is nice. Okay, you still have money to trade with, so your statistical edge will still play out. Now, look at this. This is where people gamble and they lose money. At 10% risk per trade, meaning you are risking 10% of your account size, which you shouldn't do on just one trade alone. Now, if it happens that you have four losing streams of trade, four losing streams, you have 40% drawdown, which is huge. At this point, you are gambling, and advice you don't do this. Okay, these are the rules. Things you need to know about position sizing and risk management. And number two is that always use a stop loss order. Never you enter a trade without placing your stop loss. It's very important. Okay, because if perhaps because the market is fragile, okay, if perhaps the market refuses to go, to go in line with your analysis, and it goes the contrary, you know that you've preserved your capital, which is very important. So never you enter a trade without a stop loss order. Okay. So that being said, likewise your take profit is very important. As you place your stop loss order, also place your take profit, because this will allow you to predetermine the profit in a winning trade. So that being said, you also advise to use at least risk 1% of your account to make at least 1.5 or at most 2%. I advise 2%. When you risk one, aim at making two. When you risk two, aim at making four. When you risk three, aim at making 6% return on investment. Okay, this is how you can grow your accounts and make money for yourself. So now my professional advice to you being a forex trader and as a seasoned coach that I am, okay, my advice to you is take no more than two concurrent trades at a time. Meaning it's advised you don't have two positions opened at the same time. Instead, have just one trade running. It's very important. Okay, don't have multiple positions open at the same time. It may be difficult for you to best manage this trade. Okay, but when you advance in trading, you can start doing all that. But at this point where you are still learning about forex trading, it's not advised to have two positions open. Likewise, concurrent trades should not be correlated. For example, you have two positions open. Now, the two pairs you are trading Euro USD and you are going long on Euro USD, and then you open another position USD JPY. You are short on it. Of course, these two pairs you are trading, they are correlated. Because what is the correlation between Euro USD and USD JPY is what? USD. You can see there's USD there, there's USD there. And you told your broker that though you are going long on Euro USD, meaning you are buying Euro and you are selling US dollar. And at this point now, you are now selling US dollar and you are buying Japanese yen. So what happens is the moment US dollar goes up, automatically you are losing on the other trade. And if US dollar goes down, automatically you are losing on the other trade. So these are concurrent trades that you shouldn't take. And you are advised to take a maximum of 3 trades per day. And there's an exemption to this. Instead of taking 3 trades a day, I will further advise take quality trade setups. Okay, as we progress in my subsequent videos, you're going to learn what I mean by you trading just quality trade setups. And if you're not subscribed to this YouTube channel, I advise you to subscribe and turn on the notification bell. Okay? Now let's see how you can calculate your expectancy per trade and your expected returns. Okay? Now look at this. Take note that your expectancy here means your edge per investment. That's the expectancy. Is your edge per investment. Now the expectancy per trade is calculated as your percentage win multiplied by your average win minus your percentage loss multiplied by your average loss. Now let's see an illustration. Assuming you have 50, you encounter 55% wins as a result of sticking to the rules, not risking more than 1 to 3% of your account size. Now this is what happens, and then you encounter 45% loss because the moment you stick to the rules, there's no way your loss will be more than your wins. You have more wins more than your loss. Okay? Now let's do the math together. Now your average loss, since you stick to the rules of using risking just 1% of your account on the $10,000 account size, you have just lost $100. Now your average win at this point is what? Since you are using 1.5 or 2% return on investment, but at this point you are calculating using 1.5% return on investment. You see that you just made $150. If it were 2% on investment, you just made $200. Now this is what it means now. Let's do the math together. Now your expectancy per trade is this. Having traded for a month. Now your percentage wins, you had 15% wins. Now this is your percentage win, 55%. Okay. Now your average win is now 150. This is it because you stick to what 1.5% return on investment is now $150. Now your percentage loss is $45. It's 45%, which is this, multiplied by your average loss. Since you are risking just 1% of your account, which is perfect risk management, you just lose how much? $100. Now when you do the math together, you see that you end up having profit of what? $37.50 per trade. This is the money you make trading. You just made $37.50, which is good. You are profitable. Now let's do the math together. Assuming you now took 20 trades a month. This is what this calculation is for a month you just did. Now, assuming you now took 20 trades, what do you notice? You just had $37.50 multiplied by 20. You're having $750. Also, in a year, when you multiply this 750 by 12, you just need 9,000 US dollars. I mean, you're a millionaire. This is the beauty behind you what? Maintaining proper risk management and position sizing whilst trading. Okay. Now, this is the most hard trading psychology of a retail trader because you are a retail trader. Okay. Now, why are you a retail trader? Because you brought little amount of money into the financial market to trade with. Okay. Whilst on the contrary, other big banks like the hedge funds, the market makers, the financial institutions, the big banks, they are bringing billions of naira, but you are bringing just little amount of money. Okay. Now, what should be your trading psychology whilst you trade? Now, this is it. Yes, note that successful traders think in terms of R multiples, meaning you say to yourself that you know what, I just lose one R as against you saying I just lost um for example, let's say you enter a trade, like the example we gave, where you had account size of $10,000, you are risking 3% of your account, and if that trade should go against you, and then you are using a stop loss distance of 30 pips, if that trade should go against you, you are losing $300. Now you now say to yourself that you know what, I just lost $300. When you are thinking that way, it affects your psychology because trading goes with what? Psychology. So instead of saying, you know what, I just lost $300, say I just instead you should say that I just lost one R. So when you start thinking in these R multiples, it helps you to have to be psychologically balanced whilst trading. So it's very important you thinking in terms of R multiple because when you keep thinking and just lost $300, you now say to yourself that your subconscious mind that you know what, I just lost an iPhone or an expensive gadget. If I just lost my house strength and etc. So this affects your psychology. And at that point in time, you start doing what we call revenge trading. Okay, you're not looking for setups while it's clear that there are no trading setups for that day, you are still trying to trade and you end up losing money, blowing your account, and your statistical edge won't play out. Okay, so it's advised to think in terms of what R multiples. I just lose one R, I just made one R, I just lost two R, I just made three R. Okay, think in terms of the R multiple and you'll be psychologically balanced as a trader. So now I've come to the end of this video. Please, I encourage you to please subscribe to my YouTube channel if you've not done that. Turn on the notification bell. And if you find value in this video, I advise you to please click the like button on the videos, comment, and if you have any suggestion whatsoever, feel free to suggest I will attend to each and every one of your comments on the comment section below. Okay? I love you and I value you all. And also please follow me on my Facebook page at Jerry's Forex Academy. And on this note, I'm wishing you all a very profitable forex and profitable trading and to likewise all my community of traders in Jerry's Forex Academy. And as always, you know, we are geared towards raising profitable forex traders. And as always, we are just one trade away. I love you.